Good morning and good afternoon. Thank you so much for joining us for the inaugural Small Business Anti-Displacement or SBAN conference. I hope that you enjoyed the sound bath, and as Dr. Willow Lung Amam said in her opening remarks, that you're able to use this event both to learn and connect with each other and also to rest, because we know it's been a tough last few years and you've been working very hard. I'm Anna Marie Cruz with the Initiative for a Competitive Inner City, a national nonprofit based in Boston. Our mission is to drive inclusive economic prosperity in under-resourced communities, and we do this through innovative research and programs to create jobs, income, and wealth for local residents. Our vision is to close the racial wealth gap in the United States. At ICIC, I manage one of our entrepreneurship programs called the Inner City Capital Connections, or ICCC. It's a tuition-free mini MBA for small business owners. I also lead our ecosystem engagement. And across our work with small business entrepreneurs and programs, we know that capital can be a barrier, but it can also be a catalyst for change and opportunity. And today's discussion will be dedicated to capital solutions that keep our businesses in place. We have an incredible panel of experts who are experts in the field in capital as well as policy. And I'm very thrilled to introduce them to you now. I also want to invite you, by the way, to be engaged in this discussion. Please let us know what questions you have. We will have time to answer them. And please provide your comments and feedback in the chat. So I'd like to introduce our panel for today. Tony Barengo, Senior Vice President and Credit Manager at CDC Small Business Finance. Lyric Kelkar, Policy Director at Inclusive Action for the City. Erica King, President at Greenwood Archer Capital. And Ueno, Senior Director of Investment at ICA Fund. Welcome, everyone. Okay, so the first thing is we want to know who is here. So we're going to go through some introductions, and just to make things somewhat organized, I'll just call your name. So please tell us a little bit more about yourself, your current role and your responsibilities, and perhaps even what led you to your work, and also tell us about your organization. So we'll start with Tony.
Thank you, Anna Marie. It's really great to be here. So as Anna said, my name is Tony Barengo. I'm the Senior Vice President of Credit within CDC Small Business Finance. That really is a job about reviewing loan applications and determining, okay, is this a viable deal or not? And within that, I also am a manager of our CRE division, our commercial real estate division. And so I think what really drove me to this work was being younger and just a numbers guy. I was always into that kind of thing. And then combining that with the mission of a nonprofit organization, and knowing we could, stretch the credit box and do deals and make differences in our community, really pushed me to stay with this organization in this line of work versus something else. So it's been a great opportunity here to work at CDC Small Business Finance, and we've also been able to create some really great products, which we'll kind of delve in there later. But my love for this space, I think I said before, it just really comes from that blend of the analysis side and being able to make a difference in the community.
Thank you, Tony. Looking forward to hearing more about that underwriting perspective. Next, let's go to Lyric.
Thanks so much, Anna Marie. Hi, everyone. My name is Lyric Kelkar, as Anna Marie mentioned, and I work as a policy director at Inclusive Action for the City. Our mission is to bring people together to uplift low-income and urban entrepreneurs to ensure that they have access to capital and transformative different economic development products, as well as do the policy advocacy to ensure that folks have the ability to thrive. So I am an urban planner by training, and one of the things that really brought me to this work, specifically Inclusive Action, is the way in which they approach this type of work. So all of our clients are the ones who, and what it is that they experience are the ones who inform the policy advocacy that we do. We really want to challenge the assumptions around risk and what it means to be a risky client, because we feel that those ideas are rooted in notions of racism and discriminatory practices. And we found actually through a lot of our lending products that the folks who wouldn't have access to any other forms of capital really are some of the best folks to repay their products and help build and grow businesses that are really integral to local economies. And so I'm really excited to be able to talk more about that with you all soon.
Thanks so much, Lyric, and looking forward to your thoughts on different policies and also different ways that you are advocating for our small businesses. Next, let's go to Erica.
Hi, good morning, everyone. My name is Erica King. So I am a product of Chicago South Side. So I grew up in a lot of different neighborhoods, different communities. And while growing up, I kind of realized that all of those communities kind of had a similar theme. And that theme was, the folks that lived around me were low income, most of which were living below poverty lines. In our communities, which I grew up in, we had poor transportation systems. We didn't have a lot of grocery stores with access to fresh produce. There was a lack of quality restaurants. We had subpar schools, public schools, compared to other areas and parts of Chicago. And we didn't have enough recreation centers and outlet for youth. But, we did have a few things in the South Side neighborhoods in which I grew up in. Unfortunately, we had lots of things like bars, liquor stores, gang warfare, infusion of drugs, and a lack of economic and community development. But we survived. I'm still here. So growing up, I was fortunate to be accepted to one of the most prestigious high schools in Chicago, which is Whitney Young. I have to say that for my Chicago folks that might be listening. But being a part of that school helped me really to create a network and a trajectory that led me to where I am now. I'm very grateful to have had the opportunity to not have my environment be one that shapes the trajectory of my life. But unfortunately, that's not the case for everyone. So a little bit of background about my studies. I studied finance at the University of Chicago, hoping to have a career as a sports entertainment attorney, only to become a commercial loan officer working at community banks. While working at those community banks, I really did a lot to help empower small businesses with tools necessary to really be a catalyst for improving those same communities that I grew up in and I still live in today. I won't go through all the details since working in community banks, but I'll just kind of say right now, my years in community and small business lending helped me really to earn an appreciation and a passion for working with small businesses, but also realize the lack of capital, or shall I say the lack of access to capital for Black-owned businesses, low, moderate income businesses, and other small businesses in my area. Fast forwarding today, I serve as the president of Greenwood Archer Capital, and I have the wonderful privilege to be able to work for an organization that provides solutions to support and empower small businesses and their development and their growth. And just a little bit about Greenwood Archer Capital. We are a nonprofit, mission-driven community development financial institution, or CDFI, that provides loans to underserved entrepreneurs by breaking down barriers to capital and by funding projects that work to feed and grow healthy communities. Our name pays homage to what was Black Wall Street in Tulsa, Oklahoma, as we see that through our intentionality and how we infuse capital, we can create Black Wall Streets and other communities across the nation. And just real quick, before I let the next person introduce themselves, just real quick, I think it's important to let you know our mission. And I'll be talking a little bit later about some of the products and how that fulfills our mission. But our mission is very bold. It's to lend our knowledge and our capital to reverse the impact of institutional racism, grow independent, vibrant Black communities, and create an environment led by purpose, essentially creating equity in communities.
Thank you so much, Erica, and thanks for painting that picture and also for your commitment to the community. I think it definitely gives us more context to your personal experience and how that drives you in creating change in the community. And now, last but certainly not least, Ueno.
Thank you. It's going to be hard to follow that one up, Erica. So my name is Ueno. I work at ICA, which is a nonprofit CDFI venture capital fund here in Oakland, California. And we're a little bit different from CDFIs in the sense that we invest in earlier stage, kind of high growth companies that may not be bankable at that time. So most CDFIs do more traditional loan products. And so we come in, we kind of help companies with this capital and with our support and try to get them to that bankable stage, by helping them grow. Our mission is similar to the others in the sense that, we're trying to close the racial and gender wealth gaps through capital, coaching, and connections, which we think are the three missing pieces to many underrepresented communities. And my role is the Senior Director of Investment. So I've been at the organization for about 8 years. I come from a more traditional kind of finance and economics background and really wanted to do something more meaningful. My kind of personal background, I'm originally from Japan and grew up in England, which is why I speak a little funny. But I come from a family of artists and musicians. So I was kind of the black sheep in the family and decided to pursue a more, professional or traditional career. But when I was a kid in junior high, my mother in Japan, during her rock musician career, decided to open a tofu shop. So I helped my mom open, it was like a very small factory and a storefront back in Japan in the countryside. And that really stuck with me and how difficult and how challenging it is to run a small business, open a small business with limited funding and support. So I really just love the fact that I got into this career and role because I love helping all the small businesses that really need that help here in this community. So that's a little bit about me. I think we'll get more into the details of our products, but we do a lot of convertible notes and safe notes and hybrid kind of debt equity products that, again, most CDFIs don't do. So we'll get more into that in a little bit.
Thank you so much, Yui. I don't think your accent is that funny or strange. And I want to mention, I think that the creative part of your experience, I'm sure, has influenced, your way of thinking also and your approach to capital and to investment. So we're glad that you're the black sheep of the family. Thank you for giving us that context. So our discussion today will focus a little bit on really learning more from your insights. We have you here at such a rare occasion to have so many great experts in the field to talk about these challenges that we're facing around gentrification and displacement, and also the capital expertise that you provide. So the first part of our discussion will be, what are your current observations around these challenges? So we'll go in reverse order here, but want to ask, what factors are you noticing or observing that are impacting or accelerating displacement of small businesses? And the second part to that question is, what are the limitations of the capital landscape in addressing these factors? So let's start with you, Yui.
Great, thank you. So I think, it's important to start high level sometimes with these questions. So I think, we look around and we see a lot of these big corporations like Amazon and even things like dollar stores coming in and really outcompeting many of the small businesses we see in our community. And I think one of the core issues that many of us are trying to tackle is the risk assessment when it comes to providing capital to small business. So, if you don't have a track record, if you don't have collateral, if you don't have experience, then traditional capital providers, banks, lenders just won't provide capital, which is why, if you become a big company, you don't even have to get to Amazon level, but if you become larger and you have a track record, the capital ends up going to them. And so I think for us, we've tried to change this traditional kind of risk assessment view. And so, how can we say, okay, if someone doesn't have maybe the track record, why is that? Is it because they don't have the network in their community? Is it because they didn't inherit a lot of money, or they were kind of excluded from the traditional credit system? And so by shifting that perspective, we are able to mitigate risk in different ways. And again, for us, because we're a little bit earlier stage and we provide growth capital, which is a little bit different from lending, we're able to kind of bridge that friends and family money that many people just don't have. And so, we see here in Oakland just tremendous entrepreneurs, really creative ideas, just incredible work ethic, and they just don't have that friends and family money that, for many, many more privileged communities do have. And by kind of structuring products in a way that, it still makes sense for an investor, and over time we can still see a return on the investment and see the impact in the community. That's kind of how we're trying to bridge that gap. But ultimately, I really do think it is the risk assessment piece, and I'm sure the other panelists have many great things to say about that as well.
And I'm excited to delve into the impact, the way that you're measuring impact too with some of these innovative programs and products. Erica, how about you? What are some of your observations around what's accelerating or impacting gentrification, and what's kind of missing or what's lacking in the capital landscape?
Yeah, thank you, Yui, for those comments. I mean, I completely agree. Underwriting, from my perspective, it needs to look different, right? We really need to figure out how we change the conversation about risk in communities too. It's a perceived greater risk, but that's not necessarily the case. We have to realize that there's certain things and institutions and ways of living that's been set up historically that has kind of led to the playing field not being leveled. So similar to Yui, our organization looks at underwriting different from the traditional credit box. There's no minimum credit score. Historical revenue isn't as important. We look at that if it's an existing business, but we also want to look at what are the other factors that aid and contribute towards making a solid decision as to whether or not that business can repay debt. So, I do encourage organizations to kind of really look at their underwriting and figure out if their underwriting is creating a barrier or eliminating a barrier if you're mission driven and you're set up to reach certain underserved populations. And then taking it a little bit back high level, some of the things that I've observed just kind of working in the space that I'm in is, there isn't a lot of ownership in assets and communities. So we're talking about small businesses and displacements and solutions to that. In Chicago, we have lots of different thoroughfares, different neighborhoods where you see, mixed use buildings, commercial buildings along main streets that, may be vacant, maybe, occupied with businesses that really aren't good for the community. And when you start to pick apart like who owns these businesses or who owns these assets, you'll see that many of the owners of those assets in the communities aren't people that live and are invested in the community. And so having more control over those assets could really help discourage or prevent displacement, of small businesses from that community. But being able to own those assets, there's, access to capital and other things that are needed to be able to compete. And, our organization, we have a niche. We realize we're mainly, intentioned on serving Black communities and low moderate income communities where historically, you see a picture that is, no equity in those communities, right? And not only is there no historical equity at large being built in those communities, equity is continuing to be depleted from those communities because of practices that have been in place, like, not a lot of jobs in communities. And if you don't have jobs in communities, it forces residents to travel outside of the community to go and find work. And with poor transportation systems, as I kind of alluded to before, that leads to longer commute times. That leads to less time spent with your families. That leads to other social economic issues. I can go on and talk about that. But things like having to pay more for insurance because of the neighborhood that you live in, having to travel further for basic amenities, spending more. Those things really deplete equity out of communities. So collectively, we need to figure out how we can kind of reverse that cycle and change those systems so that we can infuse more equity in communities by addressing some of these issues.
I really appreciate that holistic view and the interconnectedness of the issues that you brought up. And so far, we've heard underwriting having to maybe have a shift or a different perspective. We also heard about asset building. I'll turn it over to Lyric for additional thoughts on what you're currently observing and what's lacking in the capital landscape.
Yeah, thank you so much. So I think there are two major factors that specifically we're looking at in Los Angeles and California broadly is commercial tenant protections. So there's a significant lack of commercial tenant protections in a lot of the corridors that we serve, and I imagine my colleagues here also serve. And then the other major thing is equitable distribution of both funds and space. Certain small businesses are prioritized over other small businesses, and I think a lot of the folks here on this panel are trying to serve those small businesses who have been left out, right? So some in the informal economy, some who are considered more risky, et cetera. And so one of the limitations around that, to build off of what Erica was saying, is how is it that you get governments and other bigger institutions than our small groups to think about risk in a new way and really actually, frankly, abolish risk? Like, the idea of risk is really rooted in concepts of racism. And so how do we move towards institutionalizing the ways that Yui, Erica, myself, and Tony are underwriting, and our organizations are underwriting capital, so that they see that there is a lot of value in the folks that our different organizations serve. One of the other major limitations that we see is quickness. So the way, yes, absolutely, we underwrite loans, but for the small businesses and other businesses who can access capital from folks like Chase Bank or Wells Fargo, they can get the money a lot faster than they can from us. And so how is it that CDFIs like ours can work with larger institutions like Chase Bank so that they can also be deploying capital in a way that makes sense for the businesses that we serve? And then the last thing I'll say is that a lot of really cool ideas are coming around ownership models. So how is it that we build new ownership models for small businesses and the products that are required to service those new ownership models? Because currently a lot of financial products are not geared towards stuff like co-ops or shared equity, or like in our case, we have our project called Commercial Owned Real Estate Core. We don't have products that exist that really service these more innovative styles of owning small businesses and anti-displacement measures.
Yes, a lot of great innovations in some of these ownership programs or approaches. And then also what you talked about earlier with tenant protection. We saw some of that with the moratorium during the pandemic, but we also saw the pressure that it continued to have on small businesses that we're still experiencing changes in rates. And I think one of Dr. Loretta Lee's suggestions was a protection on evictions entirely. So Tony, let's hear from you. Any thoughts on, again, the factors that are accelerating gentrification and also what's lacking in the capital landscape?
Yeah, no, thank you. The first thing that came to my mind was, starting with the pandemic as an accelerator. We had the pandemic come out, and then we had a lot of capital put into the system to try to, really help small businesses. So that was the PPP loans and then the EIDL loans that SBA put out. And while those were, certainly necessary, what I think one of the downsides of them was it just put so much capital in the system that it started really driving prices higher. So what did that do? And we've all heard about inflation. It just makes the cost of real estate, in particular markets, even more unaffordable to the smallest of the businesses. So I think that then connects back to kind of what Yui and Erica were talking about initially. Is like, how do we, as members of our community and in these financial institutions, create products that are going to be accessible to people, that aren't going to kind of fit the mold, that can go right to Wells Fargo or to Chase. So, I think it ties back into that more flexible underwriting. Can we do low down payment programs? Erica mentioned a product with no credit score. We have something similar. So, and Yui even mentioned, taking on risk that, being that sort of friends and family capital of people who, don't have that network. So I think, again, my add to this would just be, how COVID really propelled inflation kind of at the, as an offshoot of all the capital that got pushed into the system, and then even further, putting, pressure on prices and making it more difficult for the smallest of the businesses to, compete with, with the money, get the money they need to then, buy the real estate that they're looking for, or, other assets that they need.
Yes, all great points. And I think one thing I'm hearing also is you all are tackling these big challenges, and you're figuring out which is going to be the most efficient and effective for the communities that you serve. We can't solve all of them, and it's going to take this coordination and also collaboration among our organizations. So I'd like to ask a little bit more about what that is that you're currently focused on. So what are the current priorities of your organizations? So specifically, what are the capital products and solutions that you and your organization are focused on? What are the goals with these programs? And what are you hoping for the outcome would be with these solutions? So Tony, let's start with you.
Sure. So I'd say we kind of leverage private and public capital. So we work a lot with the Small Business Administration, and a high-level overview of the SBA. Essentially in the loan products that they partner with lenders, they'll provide a guarantee on the loan. So that allows lenders to take, more risk, and we've all kind of talked about what is risk, but to take on more traditional risk than they would before. So that means doing, more loans to startups, more loans to younger businesses, more loans to people that may have had some credit dings in the past. So we'll work a lot with SBA either through what's called their 7A product, which is generally more for working capital or equipment, but you can also use it for real estate. And then they have a product called the SBA 504, which is really for fixed assets, primarily real estate. Those are two really good products, but we recognize that alone does not solve all the problems. And nor necessarily it should, but so that's where we try to partner with private sources of capital and have developed some of our own products. One of those is called our Empower 95 product, and that's a owner-occupied, it's a small business loan for commercial real estate, and it's a 95% loan-to-value product. So only requires a 5% down payment, and that I think tackles some of the affordability issues that we've all heard about, and we're trying to solve for. More flexible underwriting. We're just like Erica. We don't have a credit score minimum. We will look at projections as far as if the revenues aren't quite there to support repayment in the traditional sense. Is the trajectory sufficient? Can you get into their business plan and their ideas, and kind of believe in them as an entrepreneur to get the deal done. And so we're, like I said, we leverage the public sources of capital that are available, and then we've worked on more creative and sort of more non-traditional sources to meet the space that is there for people that are just kind of outside the SBA box, but again are still reasonable credit risk. And I think we'll talk more about that probably later, but that's one of our main focuses. Like, how can we get small businesses to own the real estate that they operate in, create jobs, and build wealth for themselves?
And sure, by having that real estate or owning that real estate, that keeps them in place, but it also ensures that longer term investment within the community and creating jobs and whatnot. And we got a comment that that said, perhaps we should call it an investment and not risk when we're talking about these decisions and funders. So we'll get into that in a little bit. Tony, thank you for addressing the asset building opportunities. I think this Empower program, what you said is it's distinct from the SBA guarantee program in that it allows you more flexibility. Just wanted to explore this a little bit more. When you're working with funders in a program like that, what might they be looking for?
Sure, I mean, a lot of times it's impact now. They want to know, like, okay, so you have this mission. Show me the people you're impacting with this. So, we will track, are we in a low to moderate income census tract? Who are what are the racial and, ethnic demographics of the business owners? Tell us the story behind, what this real estate accomplished. So, that's what we really focus on as we're putting together these products is, okay, hey, we don't necessarily just want to have some sort of a risk analysis. We actually have an impact matrix where we're looking at, like, okay, well, why couldn't they qualify for a conventional loan? We're going to track that. Like I said, racial and ethnic demographics, we're tracking that. Low to moderate income area, we're tracking that. Do they offer benefits to their employees? Things like that. So we're trying to really measure impact in a broad and deep sense. And then you can come back to these funders after you've kind of proven a concept and say, hey, look at this 50 million we deployed, and all of it, or it went to this kind of a population, and this is what it was able to create. And so we're focused on telling those stories and tracking that impact.
That's great. So it's really an open conversation with those funding sources, and also a breadth of different impact metrics that you're looking at over time.
Sure. And then, of course, they have their risk parameters, which is great for commercial real estate, because then you have some hard assets to fall back on. But I think, the first thing they want to know now is really just, how are you guys making impact? So that's what we focus on.
That's great. It's a combination. That's wonderful. So Lyric, you were talking about CORE, and I know your organization is involved with so many different programs. What are your current focus areas, and what are your goals with these programs, and how are they? What are the metrics that you're hoping to measure or see at the end of deploying these capital sources?
Yeah, it's such an excellent question. I guess even before I start, I do a little bit of framing and understanding that due to COVID in the last 2.5 to 3 years, a lot of the folks that we work with, a lot of our clients, were set back many years, because of the economic downturn. And so this is a really key moment for centering equity and what it means to meet people where they're at. And so for capital products and solutions, one of the key things that we're looking at is the spectrum of products. So like something that a street vendor might need, a street food vendor specifically might need, is very different than, say, a web-based business where they have a warehouse and they do distribution from that space, right? And so understanding that there's going to be different needs for different types of small businesses that we're working with, even if it's, even a sole proprietor or someone who only has a handful of employees. And so just really recognizing that and understanding that each of these products might be specified for different types of folks. And that's okay. Like sometimes, yes, of course, we want to have really broad impact and reach as many people as possible, but sometimes that just doesn't work if you're trying to really center equity. And so one of the key things in building these products is meeting people where they're at. And I'll name 2 specific loans that we're thinking about. Inclusive Action has one called the Raíces loan, and this is really our way of looking at emergency capital. So short terms, very small dollar loans, under $2,500, so that they can do whatever it is they need to do to ensure that they can stay in place, whether that's something as personal as like making sure that their car doesn't get repossessed because they've been investing in their business instead of their personal lives, or working capital that's required in order to take their business to the next level in the next couple of months, or pay for equipment that they're renting, et cetera. And then the other thing we're thinking about is equity investments. So similar to UE, the friends and family capital. So very small equity investments that we can assist small businesses with as they're pulling out of the pandemic and are looking to build the stabilization that's required to thrive for their business. And then the last thing I'll say in terms of outcomes and solutions, something that we're doing this entire time too, is monitoring all of the data and how it is in a more holistic way that these small businesses are growing or not growing. What are the setbacks? What are the things that help them? And from that, being able to institutionalize some of this stuff and build capacity for governments, for other larger lending institutions to make sure that they can build on these products as well. And they can understand that these different ways of investing in folks really do work. And this goes back to I love Erica's mission to lend knowledge. So we want to be lending knowledge. We can't do it alone, and it's going to take all of us, right? So how do we work together to share all of the resources that we have to broadly build the base for how it is that we're going to center equity as we support small businesses across the country?
That's great. I mean, looking at how we ultimately can demand the change by not only proving that these programs do work, but that other organizations who are mission aligned can deploy the same types of programs. So there's power in numbers, what I'm hearing there. That's such a great point. So let's go to you, Erica, about what are the programs that you're focused on? How are they addressing displacement? And what are your approaches to these challenges?
Sure. Yeah, I don't think I could have said it any better than Lyric. We have very similar programs. All of our programs, have, like I mentioned, have been introduced with intentionality in mind. So we have a program called PERC. It stands for Pathway to Enterprise for Returning Citizens. That helps provide capital to return folks previously incarcerated coming out of prison that are entrepreneurially minded and want to start businesses in their community. We have a healthy living, healthy financing product that incentivizes growers of food, transporters of fresh food, or any derivative of the two. And so it provides different incentives to encourage more folks to get into the space and bring in healthy access to foods, eliminating food deserts and food insecurities. We have a equity-like program. So I was excited to hear mentioned of equity products. And so our equity-like program really provides that friends and family money, very early stage businesses, that seed capital for businesses that may not be able to access traditional debt or our CDFI debt, that still need that equity injection in order to get businesses started. We also have a program called Empower too that supports small and minority contractors with revolving lines of credit. So I was very excited to hear meet the business where they are and provide the right type of capital for the right type of use. So this particular program provides revolving lines of credit for contractors to enable them to be able to scale. It's important because these contractors are working on projects in communities, right? Rebuilding communities. So being able to support them in the way that it's most meaningful is essential. And then, another product we have, which is very exciting to me, and it does speak to different strategies, doing things different, breaking down barriers, which all of them do. But this one in particular also looks at how we can leverage public capital with our private capital to really kind of figure out these barriers and figure out a way that we can make this make sense and level the playing field. And that product is, it's called Your Forte Our Finance. It was named and co-created in conjunction with Matt Forte, who is the former running back for the Chicago Bears. Just had to give you context about the name. But basically, we looked at, Chicago area and businesses and communities during the pandemic. This kind of theme was really raised to higher visibility in that many small businesses that have a brick and mortar may not own the asset. They may be renting. Oftentimes you look at rent and you see that it could be, is upwards of 3 times higher than what they would pay if they actually owned that asset. And during the pandemic, we realized that a lot of the businesses that weren't able to survive didn't survive because of their inability to meet up with the needs of their occupancy. There were lots of grants in our area that were issued for payroll, for other needs, but not enough to really support rent and rising rent costs. So, we looked at what the barriers were for having Black-owned businesses and other LMI businesses being able to obtain that real estate. And thinking about my banking days, someone will come to me to apply for commercial real estate. I had to ask, what's your credit score? What's, where is it? Figuring out the equity and the values therein. But the ultimate thing is, do you have 20 or 30% to put down as an equity injection towards this? And without that, you wouldn't qualify. And in addition to that 20, 30% that we're asking you to put down, do you also have a cushion over here on the side to really support that service for the next 12 months or 18 months? Well, if you're looking to fund a small business in a community that, we know that there is no equity and no wealth, how is it that this business can be able to put down 20, 30%? So that's a barrier. Long story short, we created a program that eliminates that barrier using public dollars. So we have a participation program with the state of Illinois that matches, our lending. So we're able, because of that participation, to offer 100% financing for businesses that want to acquire commercial real estate. And in addition to the 100% financing, rates are low as 3%, even in like this current rising interest rate environment. We're still able to maintain those rates at a very low cost so that we can, again, remove barriers to have, a business be able to acquire and or improve commercial real estate. That way they have more agency in communities, and they now have an asset that they can, in turn pass along to other generations. Again, essentially creating wealth and equity in communities.
Wow, 100% financing. That's incredible. And again, I think, Erica, you are reiterating the importance of looking at the holistic nature of these challenges, or how they're interrelated, and the importance of, I think what also Lyric had mentioned, meeting the clients where they are, meeting the needs of the small businesses, and really listening. Thank you for sharing those. And Yui, would love to hear about your organization's approach. What are the programs that you're focused on in addressing displacement? What are your goals with these programs and outcomes you wish to see?
Yeah, thank you. I mean, I think just on a high level, I really just love the fact that everyone is bringing up equity and equity-like investing, because this is something that we've been doing for, a decade now. And I think just now we're starting to see traction in terms of the industry, the CDFI community. I know, Tony, your organization is going to really get into this and doing revenue-based lending and kind of more equity-like products. So that's kind of, a big picture, kind of long-term goal is really to see more of this type of activity just across the board. And I think for us, we're trying to prove a model that, if we can do it here in Oakland, then other people can do it too. And I think that's the way that we want to propagate our model around the country and maybe even internationally. So that's kind of high level. But, in terms of what we do on the ground, I think, going back to the risk assessment. So, the three kind of missing pieces, the coaching, capital, and connections. The coaching piece we think is almost just as critical as the capital. So we offer an accelerator program, which is a 10-week intensive program for entrepreneurs. So, if we think a company has good potential, both in terms of the impact and kind of their business long-term growth potential, we accept them into the program. And so we really provide a hands-on, one-on-one coaching. We have experts in the field, pro bono advisors that can really help them every week doing one-on-one sessions. And so we try to get them to a point where, really we feel comfortable investing the capital. And I think one of the questions that had come up is, what do you do differently? What are these innovative underwriting policies? And I think for us, it's not just about the metrics and the business model, but it really is about the entrepreneur and getting to know them, getting to see them, fight through different adversities, how they treat their employees. These things take a little bit of time. And so for us, doing this accelerator program, working with them one-on-one, we really get to see who they are as people and not just as business owners. And that is a huge part of our kind of risk assessment, because if someone's not coachable, if someone's not, kind of treating people in a respectful way, or if they're not doing what they said they're going to do, then that's a huge red flag, or that can be kind of an alternative way of looking at risk. So that's kind of how we mitigate risk on that front. And then on the capital side, getting more specifically into that, we basically identified a huge gap in this capital continuum, which is, I think CDFIs are doing a great job of, okay, let's change the way we look at people and look at businesses. That's big. But, the truth is, a lot of companies, if they're not profitable, if they don't have good cash flow, even if you change your risk metrics, you still might not be able to lend to them. And so we really saw that, okay, we have to provide some kind of an early stage, equity investment. So again, we do these convertible notes, which it starts off as a debt product, but the intention is not to get repaid. The intention is to convert it into equity down the line. And the reason we do that is because if you invest in equity up front when the company is so small, the valuation is it's so small that you end up purchasing half the company, basically, or some large portion of it. And so that's not fair to the owners. So you have to create these convertible structures so that you can be an equity owner that's, a reasonable share, and you do it down the line. And what's unique about these products is, so we just created last year a proprietary product called the ICA Impact Note. And just a quick aside, working in this industry for so long, I've really realized that, there's a lot of flexibility in these products. I think that's something that I really push the industry to look more into is, you can work with your lawyers, you can work with other investors to really structure products in a way that work for the businesses and work for you. You don't have to continue just using loans. You don't have to, only do a convertible note that exists, as a legal template. You can actually really work the language and change the structures in a way that that you think could work. And so what we did was we actually embedded impact milestones into the legal terms. So we said, okay, if you as an entrepreneur hire this many people, provide health benefits, provide some equity distribution to your employees, we're actually going to give you an incentive by returning some of the equity that belonged to us back to the entrepreneur. So that basically creates a legal structure where now they have an incentive to do the social impact, which is what we want in the first place. So now there's a legal structure around it, and all the incentives are aligned on both sides. And it's a convertible note. So in the event that the company's not doing so well, or maybe they're not seeing the growth that we thought that they would see, we can actually elect to get paid back at 0% interest. So we're not charging any interest. This is it's an equity investment. So the goal is not to make some interest. It's really to become an equity holder. But again, not every company gets to that point. So to mitigate that risk, we actually reserve the right to get repaid. And again, the reason we did this is because so many companies or so many funders just couldn't wrap their head around, well, if you're an equity investor and you can't get repaid, how is that going to affect your returns at the end of the day? And it's true, if you invest direct equity and most of your companies go under, then your returns don't make sense. But by having the repayment structure as well as keeping the equity, the option to convert it to equity, we really believe that this is an approach that can work. So I know that was a mouthful, but if anyone wants to talk about this stuff, please feel free to reach out and we can get into more detail, and we can share all the legal stuff as well. So
it's such an innovative tool. I had a chance to look at it, and I know that one of your goals is to also share it out and create kind of a best practice. So folks, if you're interested in learning more, I'm sure Yui and the team at ICA would be happy to connect with you.
absolutely.
So there are a lot of innovations happening at all of your respective organizations. And I do want to move into questions. Yui, I think you addressed this. One of the first questions is, can you talk more specifically about innovative underwriting, and particularly with working with grant-making institutions to make lending or these products more accessible and equitable? Let's start with Tony, because I think you were touching on this a little bit with Empower.
Yeah, I mean, so with Empower, I mean, we talked about like, okay, to show us the impact, right? So, that's always been our discussion with funders. For this particular product, we actually are fortunate enough to have the starting point of the capital be our own. So, we're proving the concept now, and then as we try to further deploy this in our target markets, we'll look to raise that capital through private sources. But in some of the initial discussions we had, that was always the feedback is, okay, X organization wants to make an impact in X market. This is what they're looking for. And it always come back to the things we had talked about, like who are these business owners? What are the communities? Where are the communities? And how are you shaping those? So again, as we were putting that together, that's why we have not only a risk matrix to talk about like the typical financial risk, but also, the impact. So, that's our, kind of first entree in here. And it's still a bit of a new product. So, I'd love to kind of circle back in a couple of years and, really tell some stories of the deals we did that have, made some impact here. But again, for us, it's just going to be about measuring impact and then being able to tell those stories.
So prioritizing impact over so-called perceived risk.
Totally.
Erica and Lyric, how about you?
Gotta unmute there. Multiple ways that I can answer that question, but I think, well, first of all, our underwriting, I think that was part of the question. Like, what can we do to really break down barriers with that? I think it starts with the source of capital that we're using to be able to deploy these loans, right? So if we're talking to our funders about, this is our mission, this is what we plan to do, understanding that we have to do something different and bold and, something outside of the traditional credit box to really break down those barriers, we need a source of capital that's flexible enough that allows us the ability to do that and be innovative and, be able to accept 100% financing, be able to still pass along savings where we know this population may not be able to access, this type of capital from a traditional institution, but we can still offer something at 3%. Or we can still provide a grant on top of that to really leverage closing costs for commercial real estate deals. So having conversations with our funders about, providing flexible capital to us, ideally that's a grant, right? Because it helps build our balance sheet. We don't have to rely upon debt, because when we have debt, then it changes and shapes the decisions that we make when we're deploying that capital to our target market. And then, piggybacking on Tony too, pushing back to a funder that may say, we want to see these high volume numbers in terms of impact. Sometimes it's not about the quantity, it's more about the quality. So really pushing back and letting them know that we need to concentrate our efforts, in certain sectors and segments and industries in order to realize the quality and the qualitative impact that, our missions are set up to do. So it's not about, quick hits there, giving a little bit of money to a broad, amount of folks. It's about concentrating those efforts, digging deep, figuring out how we can attack and address the racial equity wealth gap from a variety of lenses, but really being focused and being patient and understanding that these problems didn't come about, overnight. And so it's going to take patience and long-term capital and ongoing commitments of capital for us to really tackle and address these issues.
Well, funding source is definitely a big one, but you just, I think if we had another hour to discuss this, we can delve into all these topics you just mentioned. Lyric, how about your organization? Innovative underwriting policies you can speak to?
Yeah, I'll be super quick. Just to build from what Erica is saying, yes, absolutely, funding sources. Another key thing is that our products aren't actually built to pay for our time. So our staff time is funded separately from the products themselves. That's a way to keep interest low. And then also really ensure social, I know we're talking about equity capital and social equity. To ensure social equity, you need to make sure that you're investing in the staff so that you can maintain products that are actually doing the work of investing in communities who have been disinvested. In terms of like really explicit components, we have flexible products. So even within individual products, if someone applies and they're like, we want, X amount of money, then we say, if we don't think that they actually qualify for that amount, we say like, hey, actually, we think it's less amount. Or if we think they might qualify for more, then we tell them that. And then on top of that, we also, even if we're denying a loan, we actually say you go with a business plan. So, hey, we think you should do these things over the next 6 months. Come back to us in 6 months, and we think that we could probably help you out then. And then a really specific component of the underwriting that we use is we actually don't use a social security number or an ITIN. So if they don't have that, that's not a disqualifier. And making sure that we do the technical assistance that's required to go through a loan application and really explain to them what it is that's required in order for us to be able to service a loan for them.
Thank you for that rundown. And I know that we didn't have much time, but those are all excellent strategies and approaches. So folks, for the last few minutes, I'm going to ask each of you in 30 seconds or less if you could share any final closing thoughts to our audience here. And audience, we encourage you to connect with folks via Whova, of course, and also to continue the conversation beyond today. But let's start with you, Uwe. Any closing thoughts?
Yeah, I just appreciate the time today. I think the one word that comes to mind, I had a meeting with Howard Schultz Foundation recently, and they're focused on listening. So I think listening is just really really important. So, the funders listening to us listening to entrepreneurs, us listening to each other. Even in the political realm, we got the elections going on, but really listening to both sides. I mean, I think that this whole divisiveness is really just toxic, and so I think all of us we should listen more and continue to help each other. So that's all I got. Thank you.
Great final thoughts. Erica?
I'm just, and it's hard to put this in 30 seconds, so I'll try. The topic of this discussion, is pay me in equity. I think we just need to realize that equity looks different depending on lens, depending on starting point. And we all need to realize that everybody's starting point isn't the same. So as organizations, we need to challenge ourselves at looking at things different and being bold and being innovative and using tools and figuring out how we can do extra things. It's not doing the same thing for this population that you would do for this one if we're trying to realize true equity. So just be bold, be innovative, and understand that the playing field isn't leveled, and just let's make our work intentional about figuring out ways where we can level that playing field.
Thank you. Lyric?
I think that was 30 seconds too.
I think I have to remind myself of this because I get caught up in the day-to-day and the where our funding comes from and all these different, tasks lists. Listen, all of these products were made up. Everything from the stuff that we get, the loans that our organizations get, to the stuff that we give out to people, they're made up. So especially to what Erica said, go bold, build something better. We can do it together.
Love that. And Tony?
I just think it's really exciting that we're here talking about all these innovations, right? Like the industry's, granted we have a long way to go, but the industry's really come a long way as well. And there's a lot of focus on equity and all the different, what that means and how to get there. And so I would just want to leave with a message of, hopefulness and excitement and, let's just keep marching forward.
Wonderful. Thank you all so much for these great words of wisdom, advice, and again, for sharing your expertise. This was such an awesome panel. And audience, again, we encourage you to connect with these organizations and also connect with the SBAN events, workshops, and we hope to continue to see you in the other sessions here in a moment. And thank you all for joining us once again. Take care.